Welcome to Act 211 class once again. Introduction for Financial Accounting 1. My name is Bamidele Ino. I'm to take you on this session, study session 5. I'll be covering capital and revenue expenditure. Expenditure in accounting has been broadly classified into capital and revenue expenditures. So this classification is very important because of the way they are to be applied in the preparation of our accounts and the implications on the reports that finally comes out of such an accounting system. Improper classification of capital and expenditure could lead to presenting a misleading set of financial statements. So it's important that we clarify that. So what's capital expenditure? Capital expenditure basically they are payments for the purchase of assets that can be used over and over again. Essentially, these are these represent class of assets that you normally call fixed assets. So expenditure incurred on purchase of fixed assets are classified as capital expenditure. So what are the features basically? The benefit that accrue to the organization from the use of such assets spread over several years. Now, capital expenditure also results in the purchase or acquisition of assets. The assets so purchased are called fixed assets, and they are meant to enhance the productive capacity of the organization. It's also the expenditure incurred to bring an old asset into working condition. In this stance, if you have cost to refurbish or to refurbish, for instance, and you spend a huge amount to improve on an old asset that has almost been in a state of disuse, then such an expenditure can be classified as capital. For instance, you have an office that you have been working, and you have cost to remove, for instance, the fittings there, the furnitures and fittings, and then you have to replace them with new brand, quality enhancing set of facilities. Then such expenditure can be classified as capital expenditure rather than treated as if they are maintenance expenditure items. So you can see that expenditure generally we classify them this way. We have revenue expenditure, capital expenditure. So in summary, we say expenditure that bring the economic benefit within a year, that you can consume the economic benefit within a year, will be referred to as revenue expenditure. But where the benefit will accrue to the organization for a reasonably long length of time, then you classify such expenditure as capital. On the chart there, you see expenditure classified broadly into two, revenue and capital. Under the revenue expenditure, you have what we call the operating and maintenance expenditure. Then under the capital, you have renewal, upgrade, expansion, and then construction of new factory. Briefly look at this. Under the revenue expenditure, you see operating expenditure. These are what you use for the day-to-day running of the organization and productive capacity of your business to enhance what you are doing so that you can continue to generate revenue. For instance, expenditure incurred on transport, stationaries, training, and all of that. All of these are expenditure, operating expenditure. Of course, maintenance expenditure are what you spend to bring assets, facilities that are in state of disrepair, to put them in proper shape so that they can continue to function. Expenditure incurred in repairs or maintenance of machines and things like that. These are expenditures that are incurred on a regular basis and their values are consumed up within that financial year. So they are classified as revenue expenditure. Under the capital expenditure, you have renewal. For instance, you have cost to improve on the quality of a particular asset that you're using. That it looks like it's a new one. This is a fixed asset that has been used for a long time. You're going to use it. Then you could see it as a capital expenditure. Upgrade. For instance, you have a laptop that you've been using for your activity, your business, and then they now tell you, go and upgrade this on laptop, and because you now have to give it to computer engineer, and he has to install some other components into it that enhance the product capacity of your laptop. Then expansion. You are running a business, operating on a small scale before, you expand your level of operation so that you can also produce more of the goods that you have been doing before, right? That will be considered as capital expenditure. Then of course, you open up a new factory. A new factory is involved in capital project involving massive amount of money you are investing because you want to do more, produce more. So all of these ones are broadly put together as a capital expenditure. The features of revenue expenditure, like I said earlier, previously, revenue expenditure are meant to ensure the day-to-day running of your business. The expenditure in which case the benefits accrue to your business within one financial year and does not extend to any other year. The features, the benefits usually consumed within the normal cost of the business. Expenditure which are incurred for the purchase that are meant for goods for sale. You buy a good set of goods and for resale, then such expenditure will be classified as revenue expenditure. If expenditure is inverted and to convert certain materials into final products or final finished goods for resale, then it's also will be referred to as revenue expenditure. For instance, you bought plantain, green plantain, and you process that and to convert it to plantain chips. Expenditure incurred in doing that will be classified as revenue expenditure because you have done that because you want to turn that product to that material to find a finished product for sale. Then it's also a recurring expenditure to maintain the business. The amount you spend on this is generally for a short period and usually they are not as huge as the amount you spend on capital expenditure time. What are the basic differences between the two now? Revenue expenditure. Revenue expenditure involves expenditure on items that are used on a day-to-day, are consumed on a day-to-day for the running of the business. Capital expenditure, on the other hand, are expended on assets that will last for a very long time. Revenue expenditure also, they are used up within an accounting year. However, capital expenditure benefits accrue over a reasonable length of year. Then revenue expenditure as well, they temporarily increase the profit-making capacity of the business when you do that. But capital expenditure, they do that permanently. They increase profit-making capacity of business permanently. For instance, if you buy a set of furniture today, the furniture remains there for as long as the business continues, right? But if you repair furniture today, it's a temporary thing. You still may need to incur more to repair that at a time. So that's it. Then revenue expenditure another point is that for revenue expenditure, they appear in the trading and then profit and loss accounts and usually leads to reduction in your profit. But capital expenditure don't appear in the trading profit and loss account, but rather they appear on your balance sheet, and their goal in this case increase the value of asset. That is, amount incurred on capital items increase the value of the assets. Continuation of the differences. There is also what we call capital receipts and revenue receipts. We have addressed the issue of expenditure. So we also have what we call capital receipts and revenue receipts. Revenue receipts generally refer to incomes that are generated in the normal course of the trading activities of the business. They occur in the process of sale of goods, receipt of discounts, commission, and interest on bank deposits. These are basically receipts of income. So, revenue receipts generally are related to the normal business activities. Capital receipts, on the other hand, are related not to the normal activities of the business. They occur occasionally in the business. Revenue receipts are usually credited to the profit and loss accounts. But in capital receipt, they are meant to be classified and recorded in the relevant ledger accounts. So, source of revenue receipts. Revenue receipts come from mainly sales of goods, interest from bank deposit, and then cash discounts received from payment. Then let's look at capital receipts. Like I said earlier, this money that has been invested by the owners of the business. Capital receipts represents money that has been invested by the owners of the business. This is usually what we even call, it is used to set up the business, buy equipment. Such money are normally spent on acquisition of assets and usually there for a long time. They represent receipts like what you call the share capital in the business. So typically your share capital is a type of capital receipts. Now, final accounts in relation to capital and revenue item. How do you treat this? How do they relate to your final accounts? Now, of course, we said, like I mentioned at the point, we said final accounts in general term as used in bookkeeping, basically it looked at account where the profit and loss account is determined at the end of the accounting period. So you prepare the final account where you want to evaluate or assess the performance of the business at the end of the accounting period. Examples of final accounts include 1. The trading accounts and profit and loss accounts. In the case of a manufacturer, its own account is called manufacturing accounts, trading profit and loss accounts. So a manufacturer has 3 sets of items put together called manufacturing account section, the trading account section, and the profit and loss account section. But for a non-profit making organization, we call their own final accounts, we refer to it as income and expenditure accounts. Now, it's important that we realize that the balance sheet is not referred to as an account. However, it is generally called statement of financial position or financial affairs. So you don't refer to a balance sheet as an account. Now, how would revenue, expenditure, and be treated in the case of final accounts that were mentioned here? That is the account of the trader, account of the manufacturer, and non-profit organization. Now, revenue expenditure is an expense and must be debited to the final account, right? Debited to the trading profit and loss account in the case of a trader account, debited to the manufacturing account or the trading profit and loss account in the case of a manufacturer account. And if it were to be the case of a non-for-profit organization, then it is to be debited to income and expenditure account. Now, the revenue received in this case will must be credited to each of these accounts. Revenue received will be credited in the case of the trader's account, the manufacturer account, and then the non-for-profit organization. Now, on the other hand, capital expenditure and capital receipt, they are not brought to the final account, but they are stated on the balance sheet or the statement of financial position of the business. Thank you for listening. I appreciate your time.